We pray for retentive memory. Father, we pray you make complex issues so simple for us to understand. And on the day of accountability, we shall deliver, and success shall be ours. This is what we ask in Jesus Christ's name. Amen.
Amen. Okay, so we are solving the 2020. I told you this will be the last of the number one. Then we will look at consolidated statement of cash flows. So I believe you've all finished yourself with a copy of the question. Now I'm trying to use the Microsoft Whiteboard so that I can share both the question and then the solution. Those who have been complaining that they don't have the question, it's becoming too much. So I decided to use the Microsoft Whiteboard. So at least you can. So can you see the whiteboard?
Yes.
You can also see the question.
Yeah.
Can you also see the question?
Yes.
Okay, so let us begin. Let us begin. Yeah, so one person should read the question for us. Now, can you read the question for us?
I mean, I'm organizing myself.
Hey, that looked good. Oh, you are not done?
Yes.
Okay, so let me start reading. Fato Limited. Fato Limited, a public limited liability company. Some have joined. All of you should unmute yourself. Nobody should mute himself in my class. Nobody should mute himself in my class. Abdul Kudus, Benjamin, Beta, EA, Mashud. Everybody should unmute himself. Nobody should mute them. His or herself. You all contribute. Mashud and then PMH. All of you unmute yourselves. Okay. So Fato Limited is a public limited liability company which operates in the service sector in Ghana. Fato Limited has business relationship with two other Ghanaian companies, Sakara and Sardine, which are public limited liability companies. The draft statement of financial position of these three companies are given below. So those are the three companies. Then additional information says Fato Limited on 1st October 2017 acquired 60% of the equity interest of Sakara. The cost of investment comprised of cash 360. And then blah, 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 blah. Then requirements. When you go to the requirements, it says prepare the consolidated statement of financial position for the Fato Limited Group as at 30th September 2019. So let's go to our board and then begin. Go down Fato Limited Group. Consolidated statement of financial position. That's at 30th September 2019. And then I think the statement was in thousands, right? Millions. So we put the millions of Ghana cedis. Now, so let's look at the question. Fato acquired 60% of the equity interest of what? Sakara. So if Fato bought Sakara 60%, it means Sakara is a subsidiary. Then you write subsidiary on top. Write subsidiary on top of Sakara. Then the cost of investment comprised of cash 360 at the acquisition, the fair value of non-controlling interest, blah, blah, blah. There was nothing like a disposal there, nothing like another acquisition. Then Sakara on October 1st, 2018, acquired 70% of the equity interest of Sardine for a cash consideration of this, blah, blah, blah. So Sardine 2 is also what? A subsidiary. Are you following?
Yes.
Are we following? So Sakara is Sardine is also a subsidiary. Then we continue. 3. On 1st October, Fato Limited acquired 14% of in Azuri for a cash consideration of 9. The investment was accounted as IFRS 9 financial instrument and was designated as fair value through other comprehensive income. On 1st April 2019, Fato Limited acquired an additional 16%. So 14 and later you bought 16, making it what? 30, right? So that becomes an associate. Is that clear?
Yeah.
Yes, sir.
Good. So clearly, there are two subsidiaries there. Sakara and Sadi, they are all subsidiaries. So let's start adding up. Since they are subsidiaries, let's start adding up. Let's start adding up non-current assets. So let's start adding up. So goodwill, it will be a working. Property, plant and equipment. Yeah, so 460 plus 150 plus 155. Leave it open. Forget about the investments. Then intangible assets. Intangible assets. What do you have? 99 plus 15 plus 17.5 in that order. Then current assets. So let's leave and go to current assets. Between every group, try and leave our 3 lines. That's advisable. Current assets, we have 447.5 plus 240, and then plus what? 125. Then we go to equity. So we go to equity. Yes, equity. What do we have under equity? Share capital.
Yes,
Share
please.
capital. The share capital, the parent will is 460. Parent only for now. Then other components retain earnings, they are working. So you know that. Other components retained earnings. Other components retained earnings. Then non-controlling interest. Then non-current liabilities. Yes, non-current liabilities. We have 247.5 plus
61.5.
61.5 and then plus 46.5.
46.5.
Then current liabilities. As current liabilities, we have what? 204,
204, 64,
64,
69.
and then 69. So do all your summations down. Let's do all our summations down. Can we move? Can we move?
Yes, please.
Then let's go and do our workings. So our workings, all figures
Units.
in millions of Ghana cedis. So working one, which is my group structure. So from the small analysis I made, I have seen that Fato being the parent, there is Sakara, there is Sadi, and then later they bought an associate who is called what? Invested 14% in Azuri, yeah?
Azuria.
So Azuri. Okay. So direct interest. Did Fato buy Sakara directly? Let's read. Fato acquired 60% of the equity interest of what? Sakara. So Sakara bought in 60%. It's a direct interest. Then Sakara bought Sadi, so there was no direct interest in Sadi. Then Azuri, it became 30%, right? Right? 14 and 60. 14 and 16. Is that right?
Yes, sir. Yes.
Hello? Hey, my people, you make responses difficult for me.
Yeah,
Hello?
30, 14, 16.
Okay. Then indirect interest. Indirect interest. Now, Fato bought Sakara 60%. So everything Sakara owns, Fato owns 60% of it. Here is the case, Sakara went to buy 70% of Sardine. So in Sardine, we'll get 60 of that 70, right?
Yes.
Right?
Yes.
Yes.
Making 42%. So when we sum them, the effective interest, so effective interest is 60 against 42 against what, 30, yeah?
Yes.
So if we should add NCI, that will be 40% here.
40.
Remember, it's a subsidiary. That will be 58% here.
8.
In associate, there is no NCI, right?
Yes.
So this will give us our 100% here, our 100% here, 30%. So date of control or position, date of control or position. Now, Fato acquired Sakara in 1st October 2017. Then Sakara later went to acquire Sardine in October 2018. So I married a woman in 2017. The woman gave birth in 2018. So both the woman and the child came into my life at different dates. Exactly.
Yes.
So 1st October 2017 and then 1st October 2018.
18.
Now, Azuri acquired him in 2017, and the time he became an associate was in April 2019, right?
Yes. Yes.
April 2019. At the end of the day, oh, what's the reporting date?
30th September.
What's the reporting date?
30th
30th
September.
September 2019.
30th September. So all this will be a period of how many? This is a period of what, 2 years, eh? This is a period of what, 1 year. And this is a period of what, 9 months. Is it 9 months? 6. 6, right? Is it 6 months? 6 months. April to December is 6 months. April to September is 6 months, right?
Yes.
Right?
6 months, yes.
Okay. So now let's go to our cost of investment.
Please, if we can just go back to the question that you just finished.
The what? Your voice is far. Increase your voice or
Azure, it's like I have lost on the way.
you are lost. How are you lost? Mhm.
Azure, is it on the 1st October 2017? Fato Limited acquired 14% interest in Azure.
Of Azuri. So that 14%, you didn't become a associate yet. Then later, look, on 1st April 2019, he came to buy additional 16, which now made him an associate. Are you getting it?
Yes, yes.
So he became an associate in April 2019. Can you see?
Yes, okay.
Are you okay?
Yes, I'm there.
Okay, let me try and shift this here small. Are you okay?
Yes, I'm following.
Okay, so now cost of investment. Yes, so let's see. Sakara, Sadi. Now the direct interest. Please read when the parent bought Sakara directly, how much did he pay? The question is in front of you. You should be able to identify the figure by yourself. When he bought,
360.
he bought what, 360.
360 million.
Are you sure it was 360?
Yeah, for Sakara. The cost of investment comprised of cash 360 million.
Okay, but the cost of investment comprised of a cash 360 million. So now look at this. Can you see Sakara? The investment in subsidiaries was 365 on the statement. Can you see?
Yes.
So ask yourself, why in the narrative it was 360 and then on the statement it was 365? What comes into your mind? What comes into your mind? In the narrative, it was 360. On the statement, it became 365. Meanwhile, the statement has shown clear that this was the investment in Sakara, 365. What does it tell you? Yes, what comes into your mind?
There are like other means of payment, like
Exactly. There were other means of what? Payment. So which they didn't disclose there. So this is a trick. So always you need to be careful. If you look at the information in the footnote that it's what 360 million, but on the statement of financial position, a different one is there. You must know that the one that is here is the total value of the investment. Is that clear?
yes.
So 365. What about Sadi? The day Sakara bought Sadi, how much DP? 160, right?
Yes.
Yes.
So that was not even a direct interest. That is an indirect interest. So follow your group structure. We didn't have a direct interest here, but there was an indirect interest. The indirect interest in Sadi, that's where Sakara paid what, 160, is that clear?
Yes.
So because this is an indirect interest, you will take out the indirect holding adjustment. I think I've taught you this. Have I taught you this?
Yes.
Indirect holding adjustment. Now, whatever Sakara owns, Fato owns only 60%. Here is the case, Sakara has paid 160 for a certain asset, which is representing 100%. Can Fato take all the 100%?
No. Only 60%.
Is entitled to take only what?
60%.
Only 60%. So the rest of the 40% does not belong to him. So you take that out. 40% of the 160. Calculate that for me.
That's 64.
Please, in exams, always do your best to remember this. Always do your best to remember this. Anytime there is an indirect interest, you will take out the indirect holding adjustment. Indirect holding adjustment simply means when the man bought the company, everything he owns, the parent owns 60%. Therefore, what he has paid for the company is representing 100%. Are you getting the point?
Yeah.
You don't take all the 100%. You take only the 60%. Therefore, if all the 100 has been recorded, you need to take 40 out. Is that clear?
Yeah.
Are we okay?
Yes, sir.
Yes, sir.
So sum them for me. 365 against what? 160 minus 64.
96.
96.
So that's it. Can we move on to the net assets? Can we move on to the net assets?
Yes, sir.
So we move to working 3. We move to working 3. Yes, we move to working 3. Net assets of Sakara. Then you take it what? At date of acquisition. And I also take it at date of reporting. Yes, let's go to the net assets. Sakara. So look at Sakara. This is the financial statement. Look under equity of Sakara. What is his share capital? Sakara. What is Sakara's share capital?
200.
100.
So share capital 200 at acquisition, 200 at reporting. Now, other components, which is on the statement, other components. What you see on the statement is the reported figure. How much is the reported figure?
18.5.
18.5.
18.5. Then retained earnings. Again, what you see there is the reported figure. So how much is the retained earnings?
221.
221, right?
Yes, sir.
Now, leave ample space for that. And then go and do the same for the other the other subsidiary too. So the other subsidiary, let me go up and call this person 4. Net assets of who? Sadi, right? So at date of acquisition, then at date of report, yes. So look at Sardine too. Sardine. Give me a share capital.
100.
I need more responses. How much is the share capital?
100.
100.
How much is his other components?
12.5.
12.5.
And how much is his retained earnings?
69.5.
69.5.
69.5.
Absolutely.
Yes.
69.5. Okay. So we go to the footnotes and use the footnotes to adjust them. So let's come down to our brother Sakara. If we read footnote 1, it says Fato Limited on 1st October 2016 acquired 60% of the interest of Sakara. The cost of investment comprised of cash 360. At the acquisition date, the fair value of non-controlling interest was estimated at 146. On this date, the fair value of the identifiable net assets acquired was 417.5. So the fair value of the whole net assets was 417.5. But retained earnings of Sakara were estimated to be what? 195. Can you see?
Yes.
159.5. Can you see?
159.5.
So retained earnings of Sakara at acquisition is 159.5. Whilst what? Other components were what?
13.5.
Whilst other components were what? 13.5. So 13.5. This is it. Meanwhile, they've told you that the whole net assets fair value is what? 417.5. And they say the excess in fair value is due to what? A non-depreciable land, which means that there was a non-depreciable land. You've seen this severally, right?
Yes, sir.
So there was a non-depreciable land. We don't know how much, but should we add it? Should we add it to it? The whole fair value becomes 417.5,
5.5.
right?
Yes.
So subtract them back and give me the value of the land. Subtract the three of them from it and give me the value of the land.
44.5.
Please, 2 or 3 people should confirm the result. He said 44.5. Can you confirm?
The reporting.
Is it only one person in the class?
Is it at the reporting?
No, the same thing as calculated at acquisition. I said, deduct the 3 figures from this. 44.5, right?
Yeah.
Yes, sir.
So the same 44.5 here for land. Are we okay?
Yes.
Okay. So total is, if you put a 44.5 there, then total is
484.
484.
Yes, 484.
So 484. Now, once you have gotten this, immediately you can calculate its growth. So under it, you calculate the growth. So the growth will be 484 minus 417.5, giving you what?
66.5.
60 what?
66.5.
Are you sure it is 66.5?
Yes.
Okay,
66.5.
66.5. Now, this is what I taught you earlier. Look at it. When you take the growth, then you check the other components. See if there is a growth in the other component. Is there any growth in the other components?
Yes.
The other component, is there any growth in it?
Yes.
So if there's
5.
any growth in it, you take it out. You say other components. Instead of writing that post-acquisition thing, you take the other components out. 18.5 minus what? 13.5, giving you a 5. So you take it out, and you see that the retained earnings will be left with what? 66. So this 66 is actually retained earnings. Is that clear?
61.5.
Oh, 61.5. Right?
Yes.
61.5. So that is retained earnings. So you can see that if you were doing post-acquisition, like 2 minus 2 will be 0, this would have been, you wouldn't have added this, right? Then you'd have deducted this to give you the same 61.5. Are you getting the point? Deduct 221 minus 159, see, 221 minus 159.5. Deduct it and see. It will give you the same 61.5. Are you getting the point?
Yes, sir.
Good. So instead of wasting time doing that post-acquisition something, you rather do it like this. That is my strategy. Now, once you have done this, let's go also to Sardine. I'm going to do the same thing for Sardine. If you read on Sardine, Sakara on October 1 acquired 70% of the equity interest of Sardine for a cash consideration of 160. The fair value of the 30% holding was estimated to be what? 36, and the 58% holding was 80.5. At the date of acquisition, the identifiable net assets of Sardine had a fair value of 181. Retained earnings were what? Retained earnings were what? Retained earnings were 53. So let's quickly put there 53. And then other components was what?
10.
Other components were 10. And then they said the excess is due to what? Yes, excess is due to a non-depreciable land, meaning there was a non-depreciable land there. When we add all, the fair value itself has been given us to what? 181. Is that not it?
Yes.
So calculate the value of the land.
18.
18.
Yeah.
So 18. So the same 18 here. So now add the reporting date and let's see. Add the reporting date. What are we getting? Add the reporting date. What are we getting?
200.
200.
So now we can calculate the growth. 200 minus 181, giving us what?
19.
Is there any growth in the other components?
Yes, sir.
Which is what? 12.5
2.
minus 10, right?
Yes.
Giving us what? 2. So return earnings is what? 17, right?
2.5.
No, 16.5 is 2.5.
Yes, you need to be.
The other component.
Other component is 2.5.
2.5
for the
not
group.
2.
Oh, I'm not
12.
able to detect one. Really. Oh, I'm unable to detect one eraser. Okay, so is that 12.5
Minus
10?
10.
Giving us what? 2.5.
2.5.
So
No, it's 16.5.
16.5.
So that's the retained earnings. Are you okay?
Yes.
Okay, so we can now go to our goodwill, right?
Yes.
Yeah, so goodwill. So let's put Sakara at one side and put Sadi at the other side. Yes. So cost of investment.
Cost of investment. 165.
Please, you have all written down the cost of investment. So give it to me.
165.
365.
365.
365 for Sakara. And then for Sardine.
160.
For Sardine, so 160.
Yes, sir.
Okay. Now, NCI at acquisition. Now, when they bought Sakara, read that information there and see the value of NCI. Note 1, you yourself read it. It's on the board. Read it and see the value of
146.
NCI.
146.
NCI was all out 146 for Sakara.
At acquisition.
What about Saadi?
At acquisition, the fair value of the non-controlling interest in Sakara Limited was estimated at 146,000 million.
Yes. And then what about Saadi?
36.
The 36, read well. Read well. This is why I'm asking you to read. Now, those of you who are quiet, the reason why I'm asking you to read is
80.5, sorry.
That's
those of you
30%.
who are quiet. The money is mentioned, the 36 is mentioned, was the fair value of the 30% holding.
30%,
Now,
yes.
the NCI in Sakara, was it 30% or 58%?
58.
58%. So which figure is he supposed to use?
80.5.
80.5.
So that was the mistake students made that year. So you should also not repeat the mistake. That's why I'm asking you to do it yourself. So those of you who are not responding and then you are sitting down quietly, you are doing yourself a very great disservice. So this will give us the 100% consideration.
Okay, so sir,
Yes.
it means that in this case you won't deduct indirect holding, right?
Because you've done it in the cost of investment already.
Yeah.
The reason why we've been deducting it here is in the cost of investment we deduct, but you've done it already in the cost of investment. Are you getting it?
Okay.
So 100% consideration. Sum it for us. Please add for me. Oh, today you put me the class door.
Hello, sir.
Yes,
511.
511.
511.
Sakara 511.
511. And this is what?
240.5.
240.5.
Hello, sir.
Yes.
I have a question.
Yes.
The cost of investment for SADI, we are using NCI 78%, which is 80.5.
Yes.
Why are we not using the cost of investment we calculated in our Kings 2 of 96?
Cost of investment of SADI, how much did we get?
We had 96 after deducting the indirect holding adjustment.
Oh, after deducting the indirect holding adjustment, we had 96. So who mentioned the 160? The 160 is wrong. The one who mentioned 160, we've done the cost of investment and we got 96. So there's no need using that 160 again. The total figure you got. Yes. Oh, I'm finding it difficult to get my. Okay. What did we get there? Please mention for me.
176.5.
Please, those of you, that is why I'm asking you to get involved. Those of you not getting involved, you are making a mistake. Let me go up there. Let me go up there, then you see. Let me go up there, and then you see. When we did the cost of investment.
Is the speed that makes us some of us to be silent?
Is the what?
Speed.
The speed. Okay, then I'll relax. The total we got for the cost of investment for SADI was 96. Can you see?
Yes.
Can you all see?
Yes.
Please.
So that's 96. So let's go up. Yeah, so this is 96. So it means that
Isn't the EDZ is the pink one or
The delete sign has come. So
Sir, there's
a
an
recycle
eraser
bin.
okay.
There's
see
recycle or the
behind the
recycle bin.
ruler. Behind the ruler is the eraser.
Because it's the recycle bin, I think it will delete it. Yes.
So it means this figure is wrong, right?
yes.
So give me the total now.
176.5.
For
176.
176.5.
it looks like some of you are far from your computer. So when you speak, there is a difference in the way I hear it. For what?
176.5.
176.5.
5. Okay, now take out the net assets. The net assets at acquisition. So net asset at acquisition for Sakara, what did you get? I'm seeing 417.5. Is that correct?
Yes.
417.5. What about that of Sadi? I'm seeing 181. Is it correct? Is that correct?
Yes.
Yes.
Do the deduction for me.
93.5 for Sakara.
So goodwill at acquisition. 93.5 for Sakara.
A
What
bargain
about
purchase
Sadi?
4.5.
Negative 4.5. Now watch this. Even if you don't know the name of this, what we mean is that you went to buy something. When you bought the thing, you paid extra. Are you getting it? You paid extra. The thing was 30,000 and you paid 40,000. That becomes goodwill. So if now you paid less than the 30,000, something that is being sold for 30,000, if they sell it for me at 25,000, the difference of 5,000, how will I call it?
Again.
Forget about console and come back home. You see, the reason why the console becomes confusing for you, you've always chewed certain things that under normal circumstances you know already. There are things you know already, but you've chewed them. Watch, what I'm saying is that you went to a shop, something is being sold for 30, and then they sold it for you at 25. So you got a difference of 5. That difference of 5, is it not discount received in accounting?
Yes. Yes.
Now, discount received in accounting, how do we treat it? Don't we add it to our profit?
Yes.
Don't we add it to our profit?
We do.
In normal accounting, when you get a discount received, is it not an other income you add to your profit?
Yes.
So it means that this negative goodwill, we call it a bargain purchase. It's like a discount you have gotten. So that discount, you go and add it to your profit. That is retained earnings. Is that clear?
Okay.
Is that clear?
Yes.
Yes.
So once you get a negative, you will say a bargain purchase. You will say a bargain purchase. Then you deduct that 4.5, you add that 4.5 back to reduce it to 0. To reduce it to 0. So when it reduces to 0, it means that when you go to consolidated retained earnings, you will then go and add that 4.5, is that clear? As an income. Are you getting it?
Yeah.
Please, are you okay?
Yes.
Yes.
Good. So you see that sometimes students wonder that, where from that bargain purchase is just a technical name they've given to it. It's just a discount. You have gone to buy something less than the price. It's a discount received, which you add to your income. That is all. So then the total goodwill here, was there any impairment on it? Read. Was there any impairment on the acquisition? From the reading, we didn't see any impairment, right?
No.
So the total goodwill will be what? 93.5, right?
Yeah.
Are we okay? Are we okay?
Yes. Sir.
So we can go to working 6, right? NCI. Okay. So working 6, NCI. So we have NCI, Sakara, and then Sadi. So NCI, quickly, give me the opening balance of NCI from the goodwill you calculated. From the goodwill you calculated, what is the opening balance of NCI for Sakara from the goodwill we have just calculated?
146.
NCI in Sakara is what? 146. What about NCI in Sadi? 80.5, right? Is that right?
Yeah.
Yes.
Okay. Now, once you have NCI at acquisition, the indirect holding adjustment, you take it out from the first subsidiary, that is Sakara, indirect holding. So please always remember that indirect holding adjustment, when you take it out of cost of investment for the goodwill for the the sub-subsidiary, you take it out from the subsidiary. How much is the indirect holding adjustment? 64, right? Is it 64?
Yes.
So this will give you the effective NCI. So this will give you effective NCI. Please calculate it for me. Please calculate it for me.
82.
What?
82.
82.
Yes.
Yes, sir.
And then 80.5.
85.
Then now you share the retained earnings. So if you are sharing the other components and the retained earnings. Is that clear?
Yes.
So I'll say share of other components. Share of other components. For Sakara, NCI in Sakara was what? The percentage was what? 40%, right? And then for Sadi, it was 58%, right?
Yes.
Now, when we shared, what was the other components? Please look here. Please look here. Now, look carefully here. You can see that for Sakara, the other components here was 5. Can you see the 5 here?
Yes.
Can you see the 5 here?
Yes.
It was 5. And then for sardine, it was also what?
2.
For sardine, it was what? 2.5. Can you see the 2.5?
Yes.
Yes.
Okay, so that's what we are sharing here. So that's what we are sharing here. So Sakara, it was 5. For Sakara, it was 5. And then for sardine, it was 2.5. So multiply them for me. Please multiply them for
Sakara
me.
2. Sakara 2.
2 and then sardine. 58% of 2.5.
1.45.
1.45.
1.45. You are finished sharing this. Then you also share the retained earnings. Share of retained earnings. You share the other components separately. Then you share the retained earnings to separate. For a reason, when you finish, you will see why it is clearer that way. Yes, for Sakara, when you subtract it, what do we get in the retained earnings? And then for sardine, 40% of, what did we get for Sakara's retained earnings?
61.5.
His retained earnings was 61.5 for Sakara, right?
Yes.
What about that of sardine?
16.5.
16.5. So please share them for me. 40% of 61.5.
24.6.
4.6.
24.6.
9.5.
5 point what?
9.57. 9.57.
9.57. Okay, so take your time and write, and then we continue. Take your time and write, and then we continue. Please, I believe you were following me from the beginning. You were writing, or you have notes to write from the beginning so that we can continue. When you finish, then you write.
Yes, we have notes to write from the beginning.
Oh, so then let's continue. Focus on the understanding. When we are done, I'll give you the chance to write. So once you share profit in the NCI, we will not know whether there is any impairment in any assets. So we hold on there. This is for NCI. Then we go and calculate. NCI is working number what? Please, what is the working number for NCI? 6, eh?
Yes.
So working 7. Working 7. Working 7. We will open our consolidated retained earnings. Consolidated retained earnings. Then you come far down and also open consolidated other components. So watch. I'm sending this up. Then I'll also open consolidated other components. Exactly. Now, so in the consolidated, so please watch. In the consolidated retained earnings, when you are sharing, the retained earnings you share, that's what you put there. So you give me opening balance of the parents' retained earnings first. Give me the parents' retained earnings on the statement. Fatu, on the statement, what was Fatu's retained earnings? It's right in front of you.
447.5.
One what?
447.5.
47.5.
447.5. Now, when we share retained earnings, share of retained earnings. Share of retained earnings growth. I'm looking at the growth in the retained earnings. So I'm going to share the two of them for Sakara and then for Saadi. For Sakara, parent will get 60%, and then for Saadi, they will get 42%. Is that right? Is that right?
Yeah.
No, it's not 36 or
Is it what?
42.
Look at your
36.
group structure. Look at your group structure. In Saadi, we have effective interest of 42 and NCI of 58. Is that not it?
Okay. Sorry.
Are you okay now?
Yes.
Yes, so check very well. Be careful of these petty things. You are looking at your group structure. The effective interest is the control we have over there. So the effective interest in Sardine was 42%, and the NCI became 58%. So this one we are sharing for the group, which is the 42%. So give me the value of the retained earnings for Sardine. Yes, what is retained earnings for Sardine under the net assets? Let me go up for you to see. Now, retained earnings, it was 61.5 and 16.5. Can you see here?
Yeah.
61.5 and 16.5. So, yes, so 61.5 and then 16.5. So put it there. 61.5 and then this one is 16.5. Please share for me.
36.9.
Which one is that? 36.9.
Sakara.
36.9. What about Sadi?
6.93.
6.93. Okay. So having put this down, then you go to the other components too, and that one to go and do the same for the other components. You go to the other components and go and do the same for it. So this is the other components. I'm going to do whatever I did, the same thing for other components, the same thing. So that one to give us the parents' other components, which is on the statement. Fatu, look at the statement. I've highlighted that place for you. Fatu, its other
36.5.
components was what?
36.5.
36.5. So that one too, you will share of other components. So you see, you put retained earnings in retained earnings account and put other components also in other components account. So Sakara, Sadi, yes,
60%.
Sakara will get 60%, Sadi will get 42%, right?
50%.
Yes.
What was the other components in Sakara? It was 5, right? And this was 2.5. Is that not it?
Yeah.
Let me go up for you to see. Let me go up for you to see and confirm. What is the other components? Even in NCI, when we were sharing other components, can't you see Sakara was 5 and Sadi was 2.5? Can you see?
Yes, sir.
Can you all see here?
Yes.
5 and 2.5. Excellent. So let's go. Now, once you do this, you have shared for consolidated retained earnings and consolidated other components. Now you exercise patience and then go and do all the other standards they are asking you in the question, go and solve them. So as and when you are solving the standards, some of them will affect retained earnings, some of them will also affect other components of equity. Then you treat them. Are you getting the point?
Yeah.
Yeah. So please multiply for me. You share the 5 and
3 and then 1.05. Sakara is 3.
Sakara 3.
And Sadi is 1.05.
1 point what?
05.
1.05. Okay. So that is it. Then now you move to the other standards they are giving you. So we've tackled I and II. Now let's come to III 3. Note 3. So read the note 3. Read the note 3 now, statement by statement, and let's deal with it.
Okay, so on 1st October 2017, Fata Limited acquired 14% interest in Azuri Limited for a cash consideration of 9 million. The investment was accounted.
Please analyze. When he bought the 14% interest, he bought it for 9 million. Go ahead.
The investment was accounted for under IFRS 9 financial instruments and was designated as at fair value through other comprehensive income.
So they made an election at the date we bought that financial instrument. They made an election that all fair value gains and losses should be recognized in other comprehensive income. Is that clear?
Yeah.
Go ahead.
On 1st April 2019, Fato Limited acquired an additional 16% interest in Azuri Limited for a cash consideration of 13.5 million.
Later, he went to buy additional 16%, and that was when he became an associate. Go ahead.
And achieve significant influence.
Mm-hmm.
The value of the original 14% investment on 1st April 2019 was 10.5 million.
Now, watch. You remember I taught you something last night. I said, if you move from a boy to a man, we'll perform a ceremony for you. Is that not it?
Yes.
Now, when he bought the first 14%, the value of the consideration was 9 million. At the time he bought the additional 16% and he became 30% and he now became an associate. When he moved from a boy to a man, that particular 9 million, as at the time he became an associate, the value of that 9 million has become 10.5. Has he gained or he has lost?
Yeah, good.
He has gained.
Again.
So this is working on my what? This is working on my what?
9.
9. So you will come here and say, okay, working number 9. Let me come down. Let me come down. So that. Okay, so working number 9, we can say the fair value gain, yes, on Azuri. Now, the cost of initial investment. The cost of the initial 14% interest. You said he bought it at what? 9 million, right? 9. But then the fair value at the date he became an associate, which was 1st April 2019, the fair value of that 9 became what? 10.5. So how much is the gain? How much is the gain?
1.5.
So there is a gain of 1.5 inside OCI. Can you agree? Hello?
Yes, sir.
Yes.
Hey, I have so many people online. Be careful you don't get confused. We are going to the end of the question though. Do you agree that there is a gain of 1.5 in NCI?
Yes.
Yes.
Now that is no more a normal investment, but he has become an associate, that gain, it will be transferred from the other components of equity to retain earnings. Do you agree? It's like you do a revaluation. When you revalue an asset, and then now the asset has been sold, what do? Any gain on the asset previously, you transfer it to retain earnings. True or false?
True.
The same thing applies here. We have gotten a gain of 1.5, which is in OCI. Well, we recorded it in OCI because the status of that investment was that it was a mere trade investment, available for sale investment, which we're measuring at fair value through OCI. But now it has become an associate. So its status has changed. So that fair value through OCI is no more there. Therefore, if there is any previous gain sitting in OCI, we now have to transfer it to retain earnings. Is that clear?
Okay.
Okay.
Do you understand now?
Yes, sir.
Yes.
So you go and take that money out of other comprehensive income. And other comprehensive income is part of the other components of equity. So you come here. You come to the consolidated other components of equity here. And then you take that 1.5 out over here. So I can say, yes, fair value gain on Azuri, which we found in working 9, that 1.5, I'll take it out from here. When I take it out from here, then I'll go to retained earnings. Are you following me?
Yes.
I'll go to the retained earnings. Then I'll come and see, yes, the fair value gain
on Azuri.
Fair value gain on Azuri, which we found in working 9. Then I come and add it to
1.5.
retained earnings here. Are you okay?
Yes, sir.
That is why you need to open both the retained earnings and the NCR at the same time. You cannot work one before working one because some items will move from here to that other side. So you open them together. So in an attempt to open them together, you have to open up your work. You know, retained earnings, there will be a lot of items in it. Are you getting the point? So you open up your work. Is that clear?
Yes, sir.
Good. Then move on. So
Hello,
we have
sir.
dealt with that. Now, so it means that this,
Hello,
since,
sir.
yes.
Please, I'm getting a little bit confused because the gain we made on the initial investment of 1.5.
It has been recorded in other comprehensive income. Do you agree?
Yes.
And I'm
Now
saying
we
that
have
now the status of the investment has changed from a normal investment to an associate. Are you getting it?
yes, I get that
So,
point.
since it
My
has
point
changed from
is
an associate,
my point is why didn't we take the 1.5 from the other component of equity before sharing? But we have shared and we are not taking it back because when we take the 1.5 from the SADI, that is the other component. I'm seeing 1.05.
You are seeing what?
1.05. But we are not taking 1.5.
No, it is not now 1.05.
We are doing every entries under there.
Watch. The gain here we are taking out is the particular gain on the investment, not that 1.05. So your argument is that when they share the gain itself, it got only 1.05. How do we take 1.5 out? We are taking it out from its total investment. Are you getting the point?
Yes, please. I'm okay.
Remember that other components of equity is a full account. It contains other things. Are you getting it?
Yes, sir.
It contains other things. So the balance over there is big already. So taking out 1.5 doesn't mean the previous one, the profit, the gain you got was only 1.05. How do we take 1.5 out? There are other, values in the account. Are you getting the point? Are you fine?
Yeah, I'm fine, sir. I'm fine.
Okay. So now, the same note, you can testify that the man has now become an associate. Is that not it? So since he has become an associate, you ask yourself, how does associate affect the statement of financial position? Associate, how does it affect statement of financial position? Tell me. We have done associate previously. How does associate affect the statement of financial position?
Okay, so we use the equity accounting. Then we
equity
have
accounting by doing what? You work an investment in associate. Is that not it?
Yes, sir.
So you come here and then work in 10. Investment in associate. And then you will go and recognize it as a non-current asset. Please, do you all remember? Do you all remember you should have a non-current asset value called investment in associates?
Yes.
Yeah, one line item.
Is my video on?
No, it's other guys who kept their videos on.
Okay, it's my shoot. Okay. So investment in associates. We have to measure this using what we call equity accounting. And equity accounting is the process where you hold the associate initially at cost. So the cost of investment of the associate, you hold it at cost. Now, the cost of investment Remember, there was a 14% interest. That 14% interest, its value as at today is 10.5. Do you agree?
Yes.
Do you agree?
Yes, sir.
Then he bought additional 16%. The additional 16% he bought, what was the value? The additional 16% he bought, he paid how much? 13.5. Do you agree?
13.5, yes.
So the total of the 30 becomes 10.5 plus 13.5. Please, do you agree with me?
Yes.
Will you agree with me?
Yes, sir.
Yes.
Yes.
So let me put it this way so that we are comfortable. So the cost of investment, I'm saying that so the initial 14% was 10.5. As you see, Abel, let me indicate that from working 9 so that you see. Plus the 16%, he paid 13.5. So the total cost has become what?
24.
24. Now, this 24, if the associate made any profit during the period, that profit will have to be what? Added to it. Is that clear?
Yes.
So go to the statement from where you see I. Continue reading on the associate. Let's see if he made any profit from there.
Okay, so Azuri Limited made profit after tax of 10 million and 15 million for the years to 30th September 2018 and 30th September 2019, respectively. On 30th September 2019, Pato Limited received a dividend from Azuri Limited amounting to 1 million, which has been credited to other components of equity.
Okay, which has been credited to what? Other components of equity. So you see, Azuri he paid a dividend of what? 1 million. But that dividend has been put in other components of equity. Is that correct?
No.
So what must we do?
We have to take it off. Reverse it.
We'll reverse it. So we go to other components of equity. We'll go to other components of equity. Consolidated other components of equity. This is it. They are telling us that there is an Azuri's dividend of 1 million they put there. So we reverse it. There is a dividend received from Azuri. From Azuri. How much is that dividend? 1 million. So we'll take that 1 million out. When we take that 1 million out, where are we supposed to recognize it? It's a dividend. So where are we supposed to recognize it? Where are we supposed to recognize it?
Retained earnings.
Retained earnings. So you go to retained earnings. Retained earnings. Then you recognize dividend received. Dividend received from Azul. 1. Then we add it to it. Are we okay?
Yes.
Now, what you need to be careful about is that if I go to the investment in the associate, Azuri, and this is where a lot of students get confused. So watch this particular question. I solved it for another class somewhere else, and then I seem not to get what their problem is. Watch here. If you get to the investment in associate, you could clearly see that if he made a profit and he paid the dividend out, wouldn't the dividend reduce the profit?
Yes, it will do.
So share of Azuri's growth. Over the period, Azuri has grown. So let's go and take a share. Azuri, what percentage do we have in it? What percentage interest do we have in Azuri? 30%, right? So 30% of how much profit did Azuri make for this particular year, 2019? So now read for us. Let's find out how much Azuri made for 2019 year.
So Azuri Limited made profit after tax for 10 million and 15 million for the years to 30 September 2018 and 30 September 2019 respectively.
So for this period, the financial statement year is from October 2018 to September 2019. That 1 year period, he made 15 million, right?
Yes.
15 million. But how many months have we operated with associate? 6 months. Do you remember?
Yes.
Yes.
So you multiply by 6 over 12. Do we understand? Do we understand?
Yes.
So calculate 30% of that 15 and multiply by 6 over 12 and let's see. Giving you what?
2.25.
2.25. But then he has paid some dividends, so we need to take the dividend out, right?
Yes.
Right? He has paid dividend of 1. So when we take it out, we'll get what? 1.25, which will add to his investment. So his total investment will become what?
25.25.
25.25. Now, the point is that the income we've gotten from Azuri here, that's what's it. Wouldn't it affect the parents' profit? Wouldn't the group add to their profit?
Please come again.
What? We've invested in an associate. Now we've gotten profit from the associate. Would it increase our profit?
Yeah, it will.
Yes.
So you have to go and add the share of the growth in Azuri to retain earnings. But when you are adding it, remember it's 2.25 minus 1. Can you see? Can you see?
Yeah.
Yeah.
We are giving you the full profit of 2.25, but you've already collected a dividend previously, so we take it out. Is that clear?
Yes.
So you go to the retained earnings. So let me go to the retained earnings. Yeah, so the retained earnings, that's the retained earnings. So
profit.
So Azuri, we say what? Yes.
Profit.
Share of
Profit.
Profit.
So share of Azuri's post-acquisition profit. Are you getting it? So again, it's 2.25 minus the dividend of 1. Remember the dividend, you've already recorded it. So if you record all the 2.25, it will become a double recording. Is that clear?
Yes.
So that gives us 1.25. Are we okay?
Yeah.
Okay. Then let us move on. I think we have dealt successfully with that particular associate. So now move on to IV and then read for us. Move on to IV and let's go.
So Fato Limited purchased patents amounting to 5 million to use in a project to develop new products on 1st October 2018. Fato Limited has completed the investigative phase of the project.
Now hold on. Fato Limited purchased patents. The patents were amounting to 5 million. And they said he purchased it to use for a project, to use to develop new projects. Now he has completed the investigative phase of the project. And then he's incurring an additional 3.5 million. And he has now determined that the product can be developed profitably. Go ahead. Go ahead.
Okay. Fato Limited has completed the investigative phase of the project, incurring an additional cost of 3.5 million, and has now determined that the product can be developed profitably. An effective and working prototype was created at a cost of 2 million, and in order to put the product into a condition for sale, a further 1.5 million was spent. Finally, marketing costs of 1 million were incurred. All of the above costs are included in the intangible assets of Fato Limited.
Okay. Now, what does IAS 38 intangible asset tells you about development? They said He purchased patents amount to what? 5 million. So if he has purchased patents amounting to 5 million, and then later he has incurred some other costs. Now, who can give us a clue as to the status of the other costs? Yes. Look at it carefully and think. Who can give us any clue as to the status of the other costs? Yes.
Yeah. They are sunk
Yes.
costs.
They are what?
Sunk cost.
They are sunk costs. Why are they sunk costs? Tell me. Why did you declare them as sunk costs?
Because to me, I think if the project is not profitable, there's no way we are going to get this cost incurred back. So
Yes.
that's the understanding I had to say yes.
Okay, another person. Another person should give us another clue.
Yeah, so the standard says that all research costs, related costs cannot be capitalized.
All
So
research-related costs cannot be capitalized. Excellent. Now, please, IAS 38, research and development, it says that research-related costs, you should expense them. But development costs should be capitalized. Now, why do we expense research costs? Please, I'm taking advantage of this to explain this to you because when it comes to IAS 38, mostly they can ask you a theory in the standard and ask you to explain why. Are you getting the point? Are you listening carefully?
Yes, sir.
Yes, please.
Don't say I didn't tell you. I'm not a prophet. Now, research cost is expensed. The development cost will be capitalized. My point is, why do we expense that research cost? Okay, first of all, what are the research costs here? My brother, tell us the research related costs here.
So the investigative phase is a research cost, sorry.
So that's 2 million.
One of them too as well.
But what?
Prototype. And then the marketing related costs is also recurring expenditure.
Good. So what it means is that let me first come here. Let me first find the total of that cost for you here. I think this is working 11. So let's say intangible assets. Yes. So what is the first cost we are expensing there?
Investigative phase.
Investigative fees. Go ahead.
Then we have prototype 2, the market cost.
No, see, he said Fato Limited purchase patents amounting to 5 million to use in a project to develop a new product. Fato Limited has completed the investigative phase of the project, incurring an additional cost of 3.5 million, and has now determined that the product can be developed profitably. That means that first, he has completed the investigative phase of the project, but at that time it was not profitable. But now he incurred additional 3.5 to make it what? Profitable. Are you getting the point?
Okay.
So the one he incurred to make it profitable will be capitalized. Are you getting this?
Okay.
Are you getting it? However,
yes,
they said an effective working prototype was created at a cost of 2 million. That is what you can call research cost. Are you getting the point?
Yes.
So 2 million, then what again? In order to put the product into condition for sale, a further 1.5 billion was spent, making it 3.5. Then marketing cost of what? 4.5. Are you getting it? Are you getting it?
Yes, sir.
Yes.
So working prototype 2.5. Then they said the other one is what cost? To put it into a condition for sale, how should we call that? How should we term that? How should we term that? How should we term that? Money spent to get it, ready for sale. Let's call it the preparation cost. Let's call it preparation cost. How much was it?
1.5. The working prototype is 2, not 2.5.
It's 2, not 2.5. Thank you. So 2, this is 1.5. And then the last cost there is a marketing cost, eh?
Marketing, yes.
So marketing costs 1, giving you what? 4.5. Now this 4.5 must be expense. Expensing it means it will reduce profit. So we'll go and charge it against retained earnings to reduce it. Are you getting the point?
Yes, sir.
However, my question I'm asking for the purpose of your standards, I'm chipping in. Why are we expensing research costs? My question is this. IAS 38 says that research costs, it must be expensed. So why do we expense research costs? What is the reason why we should expense research costs?
It's a sunk cost.
Hey, the rest of you who are not talking, does it mean you are not part of the class? B, Da, EA, Israel, and the rest, Alas and Shaibu, you have all muted yourself. A lot of people, Alas and Shaibu, B, Da, EA, Israel, Jocelyn, Mary, Nana Madufie, Osei, all of you have muted yourself. Does it mean you are not part of the class? I want to hear your voices, those whose names I'm mentioning. Adwa Bwedua, Alas and Shaibu, B, Da, Israel, Jocelyn, and the rest. You have all muted yourselves. Be careful. Okay. When I'm asking questions like this, students normally, they are only interested in the solution of the question they are solving, forgetting that what you are solving, the solution is already there for you to copy. But what I'm saying will not go into the solution for you to understand. So you will need to remember it at a point. So be very, very careful. I'm saying that what is the reason why research costs at that point we expense it? What is the reason why we expense it?
First, because it is a sunk cost and it has no direct relation to the product in question.
That is not the main reason. Accounting, you are an accountant. So
the main reason is that, okay, so let me try, not the main reason.
Okay. Try it. Try it. We are waiting for it.
It could be that, you see, research, you can take research into a project and later you find it to not be viable. So in that case, can you consider it to be an asset to you? No. So I think that's the reason why.
So the reason you are giving is actually correct. It makes sense. But you are speaking English. I want you to speak accounting. You are speaking English. If you tell me I can spend money and later I'll realize that it is English you are writing. I want you to speak accounting. This is what I need. I want you to speak accounting. If this question is given to you in standard and they are telling you that you should explain, how are you going to put it there? Yes, I want you to talk accounting. Yes.
Say, please. I want also
go ahead. Go ahead.
Okay, so you see, with the research, one, it's not yet developed, it's not an asset. And there are some conditions for us to capitalize development costs. So one, if there is the ability of the entity to use or sell that research after its completion, one, it has not been developed, so we can't capitalize it.
Good. So what you are saying is true, but you have moved to development. What you are saying is true. You are talking about why development costs should be what? You are talking about why development costs should be capitalized. That is what you are talking about. It is correct. But what I'm saying is that my question is that why will research costs be expensed? I'm not saying that Abdul Rafiq, please put off your video. Abdul Rafiq, put off your video. Abdul Rafiq, put off your video.
It's a running cost. It's a recurring cost.
Okay, somebody raised his hand. Who raised his hand? Yes.
I think research is expense in the year in which it was incurred. I can make a research for a project.
No, listen. What you are saying is true. Everybody knows research is expense in the year in which
I'm coming to the reason.
Good.
Because of the prudence and matching concepts. That's why we need to expense it in the year in which it was incurred.
So let's say if the development was also incurred in the same year, it's also a development cost in the same year. So if you are saying the main reason is prudence and matching, then we must match that one too, because it also happened in the same year. Do you get understanding? So any reason you give, there is a weakness for the reason. I want someone to think and tell me the accounting reason, the professional explanation of why you would not capitalize the research cost. Okay, so this is it. When we say you are capitalizing something, what does it mean? In accounting, if they say capitalize something, what does it mean?
You are adding to the
You
value.
are adding it.
You are
Adding to
what?
the value of the.
You are adding it to the cost of an asset. Is that right?
Yeah.
Yes.
You are adding it to the cost of an asset. That means you are recognizing it as an asset, right?
Yes.
Good. So if you are recognizing it as an asset, you said this. You said you are recognizing it as an asset. So recognition has come here. What is the basis for recognition of an asset? When can you recognize an asset? According to the conceptual framework, recognition criteria for an asset, it is two. What did he say?
When the cost
Step one.
It must
He
be
said
measured
one.
reliably.
Yes. If it is probable that future economic benefits from that asset will flow to the entity, is that right?
Yes.
Yes.
And then number two, if the cost can be measured what? Reliably, is that right?
Yes.
Therefore, the research cost at the research phase of a project, what my brother explained, that you don't know whether the project will succeed or not. That is true, but that is English explanation. You will say there is no evidence of economic benefit to flow from the asset. Are you getting the point? Are you getting the point?
Yes.
You will explain, accounting wise, you will explain that now recognition of research cost as an expense is in line with the conceptual framework. Conceptual framework recognition of an asset requires that an asset can only be recognized when two conditions are met. One, when it is probable that future economic benefit from the asset will flow to the entity. Two, when the cost of the asset can be measured reliably. Is that not it? Then you go further. Then you go further and explain that at the research phase of a project, there is no evidence of future economic benefit to flow from what? The asset. And that's what my brother explained. My brother who explained that. What is your name? The one who explained that. What is your name?
Nyaba.
You are what?
Nyaba.
Yes, Nyaba. What you explained that you can start a project and later you realize that it's not profitable. All that you all explained, they were correct. But you were speaking English. To put it in accounting, you explained that because it is possible you can abandon the project. All that, what it means in accounting is that there is no evidence of future economic benefit flowing from the asset. Is that clear?
Yes. Yes.
So whoever is marking your paper, this is the accounting language he is expecting to hear. You will say that recognition of an asset is in line with the conceptual framework, which requires that an asset could only be recognized, one, if there is evidence of future economic benefit to flow from the asset. Number two, if the cost of the asset can be measured reliably. Then you will say that during the research phase of a project, there is no evidence of future economic benefit to flow from the project because the project can be abandoned. Are you getting the point? So the technical language is there is no evidence of future economic benefit to flow from what? The asset. Therefore, that condition, that recognition condition for an asset has not been met. So if the recognition condition has not been met, therefore it cannot be capitalized, it will then have to be what? Expensed. Are you getting the point?
Yes, please.
Are we satisfied?
Yes, please.
Yes, sir.
So you see, the moment the question says, why is it not recognized as an asset or why is it not capitalized? Your mind should go to, they are asking you for recognition criteria. So you need to draw their attention to the recognition criteria first. That the recognition criteria requires that there must be evidence of future economic benefit flowing and then the cost must be measured reliably. But in this case, the cost of the research, it can be measured, but there is no evidence of future economic benefit. That is the key word the examiner wants to see. So that is just by the way. I think we are okay. Are we okay?
Yes.
Okay, so let's go back to our question. So we've deducted the research cost, we've expensed it here. Now let's go back. So our sister, now continue. So we finished with that intangible asset. So let's go to Note V. Read Note V for us.
Note V, okay.
Hello, sir.
Yes.
But the last sentence, they said it has been included in the intangible asset of
Yes, so what?
Fato.
Good. So when we go to the statement of financial position, intangible asset, we will go and take it out.
Okay.
We have not got to the statement. I don't like working statement and question. If I do that, you'll be confused. So you just have to understand the treatment first. When you finish and you finish all your workings, when you go to the statement, then you take it working by working and treat them. Are you getting the point?
Yes, please.
If I go back and forth, you'll be confused. So that we'll get there. Yes. So now, can you kindly take us through?
So impairment tests were conducted for both Sakara Limited and Sadi Limited
So they conducted impairment test for them. What happened?
On 30th September 2019, the recoverable amount for both cash generating units, as stated in the individual financial statement as at 30th September 2019, were Sakara Limited 712.5 million and Sadi Limited 302 million,
So the question
respectively.
is telling us that they conducted impairment test. They conducted some impairment test on the assets, on the Sakara and Sadi. But when they conducted that impairment test, they came to the realization that the recoverable amount of both of them were 712.5 and 302. Then they said that the directors of FATO felt that any impairment of assets was due to the poor performance of intangible assets. They are telling you that the impairment was as a result of what? The intangible asset. Is that clear?
Yes.
In any case, if you've learned IAS 36, what you learned on cash generation unit, if you have a group of assets and then you don't know which particular asset has impaired, but there is an obvious impairment, which asset do we attribute the obvious impairment to? Is the intangible asset, more especially goodwill. Is that clear?
Yes, sir.
Is that clear?
Yeah.
Yes, sir.
The IAS 38, more especially goodwill. That is what we. So please, I'm stressing much on IAS 38 here because the reason why I'm stressing on it is that there is a reason why I'm solving this May 2020 question with you. There is a reason why I'm solving it with you. That I'm expecting that last night it was a consolidated P&L. So I mean, I'm not a magician. I have not gone to see ICA questions with my eyes and give it to you. No. But as a rational person, I am thinking and predicting that last night they gave you question on consolidated profit or loss, which was similar to the May 2019 one, which we solved yesterday. This night, if ICA decides not to go through continuous repetition, what they've been doing in the past, every day they change the nature of the console, it means that they may give you a consolidated statement of financial position, and obviously nobody will give you a cheap one. They will give you some complex group like with some associate like this. That is what I am suspecting. And in that, the issues relating to intangible assets for this diet is very key because personally, when it comes to the standards, I'm expecting you to answer something on intangible asset. That is my own personal expectation. Are you getting the point?
Okay.
So because I'm expecting you to answer something on intangible assets, I have gone through the past question to select a past question which will address the complex group and at the same time address the intangible asset. Are you getting the understanding?
Yes, sir.
And that is why I've selected this past question for you. And you could see that both note 4 and note 5 is stressing more on intangible assets. Don't say I'm a prophet. There is a reason why my name is called Bishop. I predicted them before I realize, it is there. I just sleep. When something comes into my mind, I know, teach your students this, I teach them, they go and it is there. So take note of it so that you won't come and be saying, oh, if you knew it was coming, why don't I don't know it is coming. My spirit is just telling me that intangible asset may be examined as part of the standards, train the students on it. So once again, I asked you that what will be the reason, the rationale for not capitalizing research costs. Then I told you that should you see something like that, you should come from the angle that capitalizing at an expense is in relation with what the conceptual framework, which requires that to recognize an asset, two conditions must be met. Then you state the two conditions, that there must be evidence of future economic benefits flowing and the cost must be measured reliably. Then I come that during the research phase of a project, there is no evidence of future economic benefit flowing from the asset because the cost that will be spent at the long run can lead to abandonment of the project. So because there is no evidence of future economic benefit, any cost incurred there cannot be what? Capitalized. Therefore, it must be what? Expense. I have explained that. Then we came to the question we have seen again that in Note V, it said they conducted impairment tests on the cash generation units for both of them, Sakara and Sadi. And they are saying that their recoverable amounts are 712 and 302. However, they said the directors felt that any impairment of the asset is due to poor performance of intangible assets. It was deemed that other assets were already held at their recoverable amount. So they are telling that the rest of their assets, it looks like their value are already almost the recoverable amount. So they are not impaired. The other assets have not impaired. They said the recoverable amounts have been determined without consideration of liabilities, which all relate to financing of operations. So they are saying that they've taken the recoverable amount of only assets. Are you getting the point? Are you getting the point?
Yeah.
Yes, sir.
So now, recoverable amount of only assets in IAS 36. How do you test for impairment? In IAS 36, if you are testing for impairment, what do you do? Yes, somebody tell me. In IAS 36, how do you test for impairment? You compare the carrying amount of the asset to the recoverable amount. Is that not it?
Amount. Yes.
So now, the question has made it clear to you that the assets were tested for impairment, and then they considered only assets. So let's say test for impairment. Let's say test for impairment on asset. Please, not impairment on business combination in the goodwill, but impairment on assets. You know, there are two impairments. We have impairment on business combination goodwill, and we have impairment of individual assets. Are you getting it? Good. So the assets of Sakara, let's put assets of Sakara here and assets of Sardine over here. Now go to the statement of financial position. Give me the assets of Sakara. In the first place, goodwill. Sakara, the goodwill. What was the goodwill? When we solve the goodwill, what do you get? I think 93.5, right? Right?
Yeah.
Sardine did not have a goodwill. Rather give us a bargain purchase, if you remember. Now, go to the statement of financial position and then check their assets. Go to the statement of financial position. Check their assets. So I'm going up there for you to check. Check the assets for Sakara and Sardine. What is total assets for Sakara and then for Sardine?
565 for Sakara.
Sakara, his total assets was what?
565.
So 565 point what? So 565. And Sardine was what? Sardine was 297.
97.5.
This is their total assets. Can you see? But then, when we did their net asset, we realized that these assets they've recognized here, it was not adequate. It was not up to fair value. This is their carrying amount. Do you agree this is their carrying amount?
Yes.
Yeah.
The book values. But there was a further addition. There was a further addition when we did the net asset. Look at this. They told us that there was the excess is in fair value is due to a non-depreciable land. And we found the non-depreciable land. Do you get it? So let's go back there and look for it. Look at it in the net assets. Let me come down to net assets and you will see something interesting here. I'm coming down to the net assets so that we see what happened. Yes. Now, the net assets, you can see that for Sardine, the land was 18. Can you see?
Yes.
Additional land 18. Can you see?
Yes, sir.
Yes.
Then let's look at Sakara. Sakara, additional land was what? 44.5.
Yes.
So that is also an asset. So when we recognize it in addition, 44.5 and 18, so that we don't leave any out. Are you following?
Yeah.
Yes.
Please, are you following carefully?
Yes.
Yes, sir.
I think one of your students, look at the time I posted the work. Look at the time I posted the question. Some people are naturally serious. At the time I posted the question, this late evening, a particular student was able to go through it and call me at 12:38. Now you don't want me to sleep again. You want me to die. One guy by name Bismarck, or I say Bismarck something, he called me at 12 something, asking me that if he goes through the solution to the question, he understands everything, but the only place he's confused about is the test of the impairment, where from that extra values. And I was telling him that, yes, look at this. There was a fair value adjustment in these assets. So working 2 and 3, working 2 and 3. Now, Sakara's own was what? What was Sakara's own? Sakara, what was his own?
It was 44.5.
What about Sadi?
18.
So this is all their assets. Do you agree this is all their assets? So should I sum these? This will give me the total value of the assets. This is the total value of their assets. Please sum them for me. Please sum them for me. Sum them for me. Sakara will what?
703.
Then what?
703.
703.
Yes, please.
Please calculate it well.
$703.
Correct.
Okay.
Is it 703 or 7, what do you call it? Is it 703 or 704.5? It says 703, okay. 703. What about Sadi?
315.5.
315.5. So Sadi is 315.5. Now, they give us their recoverable amount from that footnote. They give us their recoverable amount. So when you compare it to the recoverable amount, yes, the recoverable amount. Mention it for it. They said the recoverable amount of both was what? Let me go there. Yes, please. What was the recoverable amount? It's clearly stated there. Can you see? What did he say?
Sankara is 712.
712.5.
For Sakara, so let me put it here, 712.5. What about Sadi?
302.
302. So clearly, if there is any impairment, you can see that as for Sakara, the recoverable amount rather exceeded the carrying value. So there is no impairment. But in Sardine, there is an impairment. Is that clear?
Yes.
Yes.
So Sardine, what is the impairment? 315.5 minus 302 will give you what? 13.5, right?
13.5. Yeah.
So this is an impairment of what? 13.5, right?
Yes.
Now, 13.5 impairment. How do you treat impairment? Impairment.
It's an expense. You expense it.
They said it is on intangible assets. So when we go to intangible assets, we'll go and take it out from the intangible assets. Is that clear?
Yes, sir.
Yes.
Is that clear? When we take it out from intangible assets, then apart from that, the next treatment will be what?
Retain earnings.
Retain
Retain
earnings.
earnings. But the retain earnings, remember, Sardine, we own impairment. But what interest do we have in Sardine? Sardine, what's the percentage interest we have in it?
40.
32.
30%.
Calculate that for us. What does it give you?
5.6.
5.67, right?
Yes.
Right?
Yes, sir.
So let me
Yeah.
now share of the share of impairment in Saudi. The group controls Saudi, I think, for 42%, right? I think it's 42%, right?
Yes, 42.
How many percentage does the group control Saudi? 42%, right?
Yes, sir.
Yes.
So we have 42%. 42% of that 13.5, which gives you what? Is that you go 5.67, right?
5.6. Yes.
5.67. So this 5.67 is an impairment. We have to charge it to what? We'll charge against what?
Retain earnings.
So we charge it against retained earnings. We charge it against retained earnings. Right?
Yes, sir.
Okay. So let's go back to our retained earnings. Let's go back to our retained earnings. Let's go back to our retained earnings. So this is our retained earnings. Sorry, these other components. Let's go down to retained earnings. So these are retained earnings. Yes. So 5.67. So we come here and say share of impairment in what? SADI, eh? Is SADI's intangible assets. And we found that in working our what? 12, eh? How much do we get? 5.67, eh? 5.67. Is that right?
Yes, sir.
Yes.
Now, please, when you do this, you are finished with the footnote. And I taught you that the moment you finish with the footnote, you have to go back to your workings and check if there is any working there that will affect the retained earnings. Then you recognize it. Is that not it?
Yes.
Okay. So let's go back. Let's go back to the workings from working one, and we check if there is something that should affect retained earnings, because we've done some workings previously, and retained earnings is the last thing. So if you are not careful, you will leave something you've worked out. So let's take our time quietly and go back from our workings and check everything to see whether we have actually. Now, working one is group structure. There is nothing there. Working two is cost of investment. There is nothing there. Working three, net asset. There is nothing there. Working four is also another net asset. There is nothing there. But then, yes, working five. I think working five is goodwill. Goodwill. What do you see? The bargain purchase. Can you see the bargain purchase?
Yes.
Please, can you all see the bargain purchase?
Yes.
Yes.
And we said that bargain purchase becomes an income. Let me, for the sake of your revision, let me put here into bracket and write income so that you remember income. So this income. So we'll go and charge this 4.5 towards consolidated retainers. Do you agree? So we'll go and add 4.5 bargain purchase. Are you okay? Are you okay?
Yes, sir.
Now NCI. Since we've gotten to NCI, now there is an impairment. There is an impairment in SADI. So since there is an impairment in SADI, what do? You have to take that impairment in SADI out. Is that clear?
Yes.
So let me put this impairment in SADI. Now SADI, what is the NCI percentage in SADI? 58%. Remember the parents are taking
42.
Hey, NCI, this is NCI in SADI.
NCI, okay, yeah, 50, yeah.
Remember the parent took 42.
40. Yes.
So NCI has 58. Please calculate it for me. I beg you, calculate that 58 for me. Please help me with that calculation.
7.83.
7.83. So that is it. So now we can close them up. So we can close our NCI. So now let's close our NCI and then sum them and then go. Yes, let's close our NCI. Please sum them for me. Let me go up and then sum them for me. Please sum them for me. Please sum them for me. $82 plus 2 plus 24.6.
108.6.
This one is 108.6. What about the other side? 80.5 plus 1.5 plus 9.57 minus 7.83.
83.69.
83.69. Okay, so 83.69. 83.69. So please add them. The total NCI will be what?
192.29.
192. Please confirm the figure.
Yeah, 192.29.
0.29. Okay. So now consolidated retained earnings. Please, consolidated retained earnings. Now we have to add the bargain purchase. It was in the goodwill 4.5. So add that 4.5. So please now calculate it for me. The retained earnings 447.5 plus 36.9 plus 6.93 plus 1.5 plus 1 plus 1.25 minus 4.5 plus 4.5 minus 5.67. Please calculate it for me.
$489.41.
489. Please, somebody is mentioning a figure. Two people should confirm. She said 4 something something.
489.41.
489.41. Please, can somebody confirm it? So that we won't go and come back. Okay, so if it's confirmed, then let's go and sum the other components carefully. Please help me with my other components too. Sum them for me. Sum them for me. Yes. 36.5 plus 3 plus 1.05 minus 1.5 minus 1. What am I getting?
38.05.
8.05.
38.05. So that is it. Let's go and then sum the rest. Okay, so investment in associate, we've summed it already. Intangible, we've summed all this. Transfer, or we've done all this. So it means virtually we finished. So I'm giving you the chance to copy the solution, the working. Then when you are done, we'll balance the statement off. So please copy the working. This is the working. I'm going to start from working 1 for you. This is working 1. Are you okay? Is the size okay?
Yes.
Yes, please.
Okay, so copy working 1. Take your time and copy. It's always better to relax. It's always better to relax. Take your time and understand everything you are doing. Is that clear? If you understand and you practice, now you will see that if you understand and you practice, you will see that now when you are solving, you know what you are doing. Not that you are writing and solving and then writing at the same time, listening to the explanation, copying at the same time, that you become confused. It's
So
rather
we
better to take your time.
We are taking short to copy later.
You are taking short. So have you taken short of working 1?
Yes, please.
So working 2, cost of investment and a net asset here. Take short of this. Are you okay?
Yes,
Sir,
please.
please, working 1 again. I was opening my camera.
I'll be that too. Yes. Take this. Are you okay? Are you okay?
Yes, sir.
Okay. Then working 2. So this is working 2, the page 2. So let's call this page 2. Take short of page 2. Are you okay?
Yes, sir.
Then let's go to page 3. So take short of the whole net assets again. Take short of the whole net asset to make it clearer. Call this page 3. Are you fine?
Yes, sir.
Then call this one page 4. Call this one page 4. Are we okay?
Yes, please.
Yes, sir.
Then call the goodwill page 5. Good, we'll call it page 5. Are you okay?
Yes.
Yes, sir.
Then call the NCI page 6. Call the NCI page 6. Are you okay?
Yes.
Then call the retained earnings page 7. Call the retained earnings page 7. Can we move on?
Yes, sir.
Call the other components page 8. Can we move on?
Yeah.
Fair value gain on Azul, we call it page 9. Let me go up a bit so that you take all. Yes, so call this page 9. Are you okay?
Yes.
Are you okay?
Yes, sir.
Can I go?
Proceed, sir.
Can I go?
Yes, sir.
Then the last one. I think this is the last one. Take it. Are you okay?
Yes, please.
So can we go and balance the statement now? Can we go and balance the statement now?
Yeah.
So please, the screenshots you've taken right after the lesson, please share it for them. The video will be ready in our 30 minutes time. The video will be ready now. I've put in measures that immediately I finish the discussion, by 30 minutes time, the video should be ready. So let's go to working the statement and balance. So you will mention your workings for me. Then I'll use you to balance the statement. Since you've taken the shots, you will mention the workings for me. Then we'll use you to balance the statement. Okay, so goodwill. What did we get for the goodwill? Let's use the workings. Let's use the workings to fill it. Working 1 is good structure. It doesn't affect it. Working 2 is cost of investment. Nothing there. Working 3, net assets of who? Working 3 was net assets of who? Sakara. Right?
Mm-hmm.
So the non-depreciable land was how much? It's non-depreciable land was how much?
For Sakara was 44.5.
So plus 44.5. So plus 44.5 here. Then the next one is also Sadi. Its land was what? 18, right?
18. Yes.
Good. Then that was working 3 and 4. Working 5 was what? Goodwill. Give me the value of the goodwill.
93.5.
93.5. 93.5. Then after goodwill, the next one was what? NCI. Give me the value of NCI.
82 for Sakara. Then
the total.
18.5.
The total.
Okay. We did write the total. I'm checking it.
Oh, what? Under it, I added the total there.
Yes.
You got 192.2.
For which one?
Yes, 18.
I added total NCI for the two of them.
No, we didn't do it.
192.29. 192.29.
192.29. Okay, when you finish, I'll go there so that you take it properly. That's
Okay,
NCI.
yes,
After NCI, what
Is
did you give me? The retained earnings. Retained earnings was what? Retained earnings was what?
489.41.
489.41.
So the retained earnings, I think we have to add it to the other components, or will you use it?
No. The
other component is there.
Oh, okay. Sister, I explained this to you that other components has its account. Retained earnings also has its account. So there are two different things. Yes, other components. Other components.
38.05.
From there, which working did we move to?
The fair value gain.
Fair value gains, which we have done already. We treated it already in the retained earnings. Then from there,
investment
in associates.
So investment in associates, and we got what? So we put it here.
25.25.
We put it here, investment in Azul. Oh, why is my thing now misbehaving? So investment in Azul. You said you got what?
25.25.
25.25.
25.25. You put it there. Then the next thing was what? The next thing was
Intangible
what?
assets.
Intangible assets.
Intangible assets.
Intangible asset. What did we get?
4.5.
4.5. So the 4.5, we're taking it out, right? We are expensing it. Do you remember?
Yeah.
Yes.
Do you remember we're expensing that 4.5? So we took it out of the intangible assets. They
Yes.
say it has been recognized in it. So we took it out. Then what's the next thing?
The test for impairment, the last thing.
So we had a payment of what? 13.5. We also take that one too out. Is that clear?
Yes.
Is that clear?
Yeah.
Yes.
Okay, so now we can close. I think we finished, right? So we can close the rest. So please sum them for me. Close the PP and sum it for me. Please close the PP and sum it for me. Please close the PP, sum it for me. And let's close. Yes, PP gives you what?
827.5.
827.5.
Intangible asset gives us what?
113.5.
113.5. Yes, current asset gives us what? Current asset gives us what?
812.5.
812.5. Then let's go to, okay, so all these are reported. Let's go to the non-current liabilities. Sum the non-current liabilities for me.
So please, the current assets are at 700.
Oh, check your summation well. Check your summation well.
Please kindly scroll up and let me see.
That's 447.5 plus 240 plus 125.
Oh, okay. I thought it was 1.5.
Are you okay?
Yeah, 812.
Non-current liabilities, please add them for me. Non-current liabilities. Who is adding for me?
355.5.
355.5. Oh, why is my board now misbehaving? I'm coming in. Where's my board now misbehaving? Yes, you said I got 3 what?
355.5.
355.5. Then current liabilities. Current liabilities.
337.
337.
Okay. So let's sum the equity and liabilities and then sum this and see if we will balance. We must balance. Once we've treated all the footnotes accurately, it should definitely balance. So you sum the total assets for me first. Sum total assets for us and let's see. That's for Consolidated. The standards that they put in Consolidated are small, so you should always be able to, at least if you can balance 18 or 20 there, you should get. Yes, sum them. Sum them for us. Are we fine?
Yeah, it has balanced.
What's the sum?
1872.25.
1872.
0.25.
0.25. Confirmed.
Then let's go and sum the equity and liabilities too. What did the equity and liabilities give you?
2.25.
The same figure?
Yes, please.
One what?
872.25.
Balance.
So you balance neatly. So I think this solution will give you a more clearer understanding. Is there any place you need to take? Since somebody asked a question here, let me sort the person out. He said it's sunk cost and all those people. Okay. So you see, you see those sunk cost. Management accounting, did you sunk cost. We are not doing management accounting here. Yes, it is true, it's a sunk cost, but per reporting, the criteria for recognition of assets has not been met. That is what the examiner wants to see. Please, is there any place you need to take a screenshot before we close?
The work is
Where?
The statement of financial position.
Yes, the statement, because now we balance with the statement. Oh. Okay, so please let me position it well so that you take it. So take this one as page 1. Take this as, let me bring it from the beginning so that you take this one as page 1. Have you done that? Are you okay?
Yes, sir.
Can I move?
Yes, you can.
Then the equity and liabilities too. Take it.
Yes,
Have you done?
Yes. Please, basically, depending on the nature of the question, then in regards to the summary that we did yesterday.
Yes.
So depending on the nature of the question, then you just look
Exactly. Depending on, you can see that this one, normally when it has to do with statement of financial position, the issues are not too much. Normally it is the P&L. You see, ICA, what they sought to do is that they've realized that the P&L is easy. You can finish in no time. So they put in a lot of things. Have you realized that? Have you realized that anytime it's P&L, they put in a lot of information?
Yeah.
But when it is statement of financial position, take it from me, their interest is to know how you'll be able to manage the subsidiaries. Are you getting the point?
Yes.
The additional subsidiary, if there is an additional, what do you call it, associate and the rest, the focus on it is how you'll be able to manage those subsidiaries and the associates. Are you getting the point?
Yes.
So I believe that, look, people, let's be frank. Let me come back here. Let's be frank. In this rush hour past questions that we saw, what I have done with you on console so far, I think I've satisfied you to some extent.
Yes.
Hello? I think I've satisfied you to some extent.
Yes.
At least, for now, you should be able, in fact, going to the exam, so I'm telling you that if you ask me, if I'm the one going to write the exams, though I'll revise my P&L all right, but where I'll make sure that I have it 99% before I go to the exam, so is statement of financial position, complex groups. More especially, look at this May 2021. It has 2 subsidiaries and an associate. That one is more bigger. May 2020. 2 subsidiaries and associate. This particular question. When you finish, don't forget consolidated statement of cash flow. That's what we'll do next. Consolidated statement of cash flows. Consolidated statement of cash flows. That's what we'll do next. Then the last thing we'll do is the foreign subsidiary. So we'll solve about 2 examples on the what do you call it? Statement of cash flows. Then we come and solve another about 2 examples on foreign subsidiary. But then we'll do foreign subsidiary fairly easier. You just have to know which of the figures, whether you are using opening figures or closing figures and an average figures. That is what you need to know, and then how to balance it off. So what we'll do is that for the sake of time, we have looked at the complex group. Let's deal with the consolidated statement of cash flows quickly, and then delve into foreign subsidiaries is easy, but students don't remember it easily because of the values we've been using to do the conversion. Some of the items, you know, P&L is for the year. They tell you it's for the whole year. So since it's for the whole year, you have to use average rate for the year. Are you getting it? Statement of financial position, closing balance, when it is share capital, equity values, opening, and then the rest. Are you getting? So you have to know what values to use to convert. So I always advise that this one, foreign subsidiary, should be treated in the last minute so that you don't forget it, about 1 week or 2 weeks to exams. So our strategy be that we've tackled the complex group now. Now let's tackle consolidated statement of cash flows. When we tackle it, let's move quickly to business valuation and capital reduction scheme and secure ourselves there. When we secure ourselves there, let's move to interpretation and secure ourselves there. Interpretation, we will look at interpretation of the normal statement of profit or loss and statement of financial position. Then we look at interpretation of the statement of cash flows. Trust me, this diet, looking at what has been examined over the years, I am expecting something on cash flow. Personally, my personal expectation, something on cash flow, be it console or interpretation. So let's do it and do it well, so that when you go and sit down, the confidence is there. Are you getting the point?
Yes.
All right. So on that note, I think we've had a good day. We will meet again next week per the timetable. Somebody has asked us a question. He said, please, I'd like to share this. Working 4, working 5, working 6. You need them. Better, you need them.
Yes, please.
So you should just speak, because when we are aggressive, normally sometimes you don't even look at what somebody has posted in there. So let's go to working 4, 5, 6 for her. You take a screenshot. She has also been here for 2 hours. We can't leave her out. Yes, please, this is working 4. Take it. Are you okay?
Yes.
This is working 5. Goodwill. Take it. Are you okay?
Yes.
Then this is working 6. NCI. So please, those who didn't see the total of the NCI, that is it. It is under here. I added it to get 192.29. Can you see now?
Yes.
Are we okay?
Yes.
So I believe we've had a good day. Due to certain factors,
Hello?
we spent more time on yes. Yes.
Can we please go to the statement?
The statement.
Yes.
You've not taken it.
No, like there is something I want to clarify
Okay.
for at least those who maybe will copy later on the page.
Yes.
When you look at the share capital, you see it's not brought to the figure is not brought to the column side.
Oh,
so
sorry.
maybe those who are copying later.
Sorry. So those who mentioned the figure from where or they have put it there and they've calculated.
Yes.
Yeah, we did. We are.
Okay, thank you. Thank you, my brother. Are we okay? So I'm sure we've had a good day. It's been very interesting. This question had a lot of technicalities because of the impairment. I beg you, and I beg you, learn and learn hard. And I believe that now, if you do all this, after I've fired you your console very well, I've fired you your business valuation and capital reduction scheme very, very well. And after you are fortunate now. This diet, definitely, I mean, I'm expecting something on business valuation, which is fairly easier. So your position is stronger. Your position is stronger. You are writing the paper at a time where we are expecting interesting things to come out. At least business valuation has been examined continuously for a while now. Last night it was business valuation. It was this thing, right? It was reconstruction, right?
Yes.
Yes, I think reconstruction has been examined 2 times. If they don't follow the trend and decide to switch, maybe we'll have a nice business valuation, which is fairly easier. Let's master our console. Let's master our business valuation and capital reduction system. Let's deal with our interpretation very well. As for standards, I always tell students that the standards are many. And so in as much as they are teaching you, you may be forgetting the other ones. So now that you have time, what you have to do is to master these ones quickly. Your console, your interpretation, your business valuation and capital reduction scheme. Then now, the standards that you have been taught, when it gets to last minute, you have time. You use your last minute time to go over the standards over and over and over and over and over with the intention that, let's assume you go to the exams, or when you are writing exams, as a student, you need to be very tactical, even though you are learning the whole syllabus. But at the time you are going to the exams, or 1 week to exam, that is not the time you carry the whole syllabus like a handbag. No, you have learned the whole syllabus, you've understood it. Then now you are going to write exams strategically as a student. If the console 20 marks calculation and 5 marks theory, let's assume you are able to work your way out, and then you are able to make about 18 from console. With these strategies I've taught you, if you learn it very well, look, you lose about 10 ticks before you lose 1 mark. So if you make about 18 from console, then business valuation and capital reduction scheme, that 15 marks, you just make 10. Don't worry, you make 10, leave 5 for them. If you go to interpretation, that 15 marks, you just make 10. You just make 10. These 3 alone. So if you can answer your console within about 35 minutes, you can answer your business valuation and this thing to about 35 minutes. And then you can also answer your interpretation also about 35 minutes. Use about 15 to 20 minutes for the ratios or whatever, and then use about 15 minutes to explain. You have this. It means that within 1.5 hours, this is 70, 105. So 105 is what? 105 or 60 minutes is 1 hour. So within 1 hour
45 minutes.
Within 1 hour 45 minutes, you have been able to do this. Now you are left with what? 1 hour and 15 minutes more. So that 1 hour and 15 minutes, look, your 15 minutes over there to make it 2 hours can take care of the theories. That is sustainability reporting, ethics and governance, those issues. Look, don't worry yourself there. That place, don't worry yourself there. If you go and take even that 15 marks, you go and take 6. Who can have 6? Then now the last 1 hour, the 1 hour there, invest it in your standard. If you invest about 45 minutes on the standard, everyone you take within, let's say 8 minutes, move. Now the standard, the 30 marks. Even if you don't get and then you out of the 30, you get 10 out of 30, put 10 po, I'm sure you pass the paper. That is about what, 30, 48, 54. You pass the paper. So please, you are not going to the exam so to work for 100%, 90%, and I can fine. You are human beings. If it comes and they give you an award, thank God. But that is not your target. So I beg you, try and learn to the extent that last minute when you have 2 days and you are revising, you can focus on the standards and learn them over and over and over and over and over. So that when you go, the standards is the area where majority of the students fail. They are simply not able to answer the standard. So go and then use the last 2 days. So when you are doing revision, if at the time you are doing revision, you are learning console and business valuation, that thing, then you are behind. Business valuation, console, and you must kill them at least 1 week before exams. Then about 2 days or the last day to the paper, standards, focus well. So that out of the 30, I understand the challenge. Most of you forget the loss. You let them take 20 and take just 10, you'll pass your paper. So please, program yourself very well. And I mean, I'm very absolute in my confidence that with all this we have done, at the end of the diet match, we will smile. Our chances of passing will get brighter and better every day. Let us continue to work that way and realize the dream. On that note, we will meet again somewhere within the next week. Till then, may the good Lord be with us all.